Forget the headlines, forget the noise. Let's talk about what's actually happening with SoFi Technologies. Is it actually true that this stock will reach 75, or is it just a foolish prediction? This isn't about hype. It's about dissecting the company, its numbers, and the market sentiment that's driving its stock. As of today, we're seeing SoFi trading around the $23.65 mark. That's a significant rebound from its 52-week low of roughly $6.47, and it's approaching its 52-week high of $25.11. The recent run has been fueled by a series of powerful catalysts, but as wise investors, we need to understand if this is a sustainable climb or a temporary surge. Let's break it down into the core components that every investor, from the retail trader to the institutional heavyweight, should be tracking. The financial services powerhouse, a look under the hood. SoFi's core thesis is simple. Become the one-stop shop for all your financial needs. They're not just a bank, they're a fully integrated fintech ecosystem. This financial services productivity loop is the engine driving their growth. They acquire a member with one product, like a student loan refinance, and then cross-sell them into a savings account, a credit card, or an investment account. This strategy is working. In their latest quarterly report, SoFi announced record-breaking numbers. Adjusted net revenue surged to $858 million, a 44% year-over-year increase. Their member base exploded, adding a record 850,000 new members, bringing the total to 11.7 million. This isn't just growth for growth's sake. It's a testament to the effectiveness of their platform. And what's the key to this? It's the diversification of their revenue streams. For years, SoFi was heavily reliant on its lending business, particularly student loans. The student loan moratorium created a headwind, but what did they do? They built out their other segments. Now, their financial services and technology platform segments are not only profitable, but are driving a significant portion of their revenue, with fee-based revenue now exceeding an annualized rate of $1.5 billion. This is a critical development. It shows they're not a one-trick pony. They are a multifaceted financial institution. The banking charter. The game changer. The SoFi Bank Charter is arguably the single most important development in the company's history. Before they had the charter, they were a fintech company that had to partner with other banks to offer banking products. This meant paying fees and having less control over their own destiny. With the charter, SoFi can now hold deposits and lend money directly. This gives them a massive competitive advantage. They can now fund their loans with low-cost deposits from their high-yield savings accounts, which currently offer a very competitive APY. This significantly lowers their cost of capital, which in turn allows them to offer more attractive rates to their members and boost their profitability. The bank charter is the foundation upon which SoFi's long-term success is being built. It's the difference between being a middleman and being the whole operation. The technology platform, Galileo, and the B2B play. Let's not forget about Galileo. The acquisition of this payments and technology platform was a masterstroke. Galileo is the picks and shovels for the modern fintech gold rush. It provides the back-end infrastructure that powers other fintech companies and traditional financial institutions. SoFi now has a powerful B2B component to its business. Galileo's platform allows SoFi to embed its technology and services into other companies' products, creating another high-margin, capital-light revenue stream. The synergy is undeniable. Galileo's technology powers SoFi's own products, creating a seamless user experience. And the data and scale from SoFi's operations help to refine and improve Galileo's platform for its other clients. This vertical integration is a massive moat for SoFi, and it's a key reason why they can innovate faster than their competitors. The Analyst and Market View. A tale of two sentiments. Now, let's address the elephant in the room. The valuation. SoFi is not cheap. The stock currently trades at a high price-to-earnings ratio. While the company is now profitable, its valuation reflects high expectations for future growth. This is where the wisdom of a long-term investor comes into play. We're seeing a divided opinion from Wall Street analysts. Some have a buy rating, citing the company's strong growth, diversified business model, and the strategic advantages of its bank charter. They believe the current valuation is justified by the company's long-term potential. Others are more cautious, with a hold rating, pointing to the elevated valuation and the competitive landscape. The consensus price target among analysts is currently below the stock's current trading price, suggesting a level of skepticism about the sustainability of the recent rally. This is where the short interest comes in. While the short interest has been declining, it still remains a significant factor. A high short interest can sometimes be a bullish indicator for a potential short squeeze, but it also reflects a significant number of investors who believe the stock is overvalued and is headed for a correction. It's a tug-of-war between the bulls and the bears, and the outcome will likely be determined by the company's ability to continue to execute on its ambitious growth plan. What investors should be watching now? So, what should you be looking for as an investor? Sustained profitability and EPS growth. SoFi has turned a corner on profitability. We need to see them consistently deliver positive earnings per share. Their recent Q2 EPS of 8 cents beat analyst expectations, and the company has raised its full-year guidance for 2025. This is the single most important metric to track. Member and product growth. The foundation of the SoFi model is its membership base. We need to see the company continue to add new members and, more importantly, increase the number of products each member uses. This is the key to their long-term revenue and profitability. Lending and originations. Keep a close eye on their lending segment. While they are diversifying, lending remains a major part of their business. We need to see strong, disciplined growth in loan originations, particularly in personal and student loans, without compromising credit quality. Galileo's performance. The B2B segment is a high-margin business. We need to see continued growth in Galileo's client base and transaction volume. This will be a key driver of future profitability and a major differentiator for SoFi. Market conditions. The broader economic environment, including interest rates and consumer spending, will have a direct impact on SoFi's business. Keep an eye on the Fed's decisions and their potential impact on lending rates in the housing market. The final word. SoFi is a company in a fascinating transition. It's moving from a high-growth, unprofitable fintech to a diversified, profitable, and fully chartered financial institution. The recent stock performance reflects a newfound optimism about the company's ability to execute on this vision. However, the journey is not without risk. The valuation is high, and the competition is fierce. As a wise investor, your focus should be on the fundamentals. Can they continue to grow their member base? Can they increase cross-selling? Can they maintain profitability and expand their margins? If the answer to these questions is a resounding yes, then SoFi has the potential to be a long-term winner. But if they stumble, the market's high expectations could lead to a swift and painful reevaluation. The data is on the screen. The numbers are clear. The narrative is unfolding. It's up to you to decide whether you're